Imagine waking up to find your bank account frozen. Not because of fraud, not because of mistake, but because the entire financial system has quietly imploded overnight. No headlines, no warnings, just silence. That's not the plot of a dystopian thriller. It's exactly what happened to millions of people during a crisis so obscure, so deliberately buried by history, that most economists today wouldn't recognize its name. And yet, every warning sign we see in our economy today, the surging debt, the fragile banking networks, the blind faith in digital liquidity, was flashing red in that very moment, nearly a century ago. This isn't just a story about the past. It's a mirror, and if we refuse to look, we'll replay the same catastrophe with even higher stakes. The crisis I'm talking about erupted in 1931, not in New York or London, but in a place few expected, Vienna. It began with the collapse of a single bank, Creditanstalt, the largest financial institution in Central Europe, a pillar of stability backed by one of the continent's oldest banking dynasties. On the surface, it seemed like a regional blip, but within weeks, panic spread like wildfire across borders, toppling banks from Budapest to Berlin, freezing credit in Paris, and triggering massive withdrawals in London. By summer, the contagion had left the Atlantic, slamming into an already weakened U.S. economy and turning the Great Depression from a severe recession into a global economic collapse. What made this crisis so dangerous wasn't just its speed, it was its invisibility. Unlike the 1929 stock market crash, which played out in headlines and ticker tape, the Creditanstalt collapse unfolded in boardrooms and telegrams, obscured by nationalist rhetoric and diplomatic silence. Governments downplayed it. Central banks whispered reassurances. The press dismissed it as continental turmoil. But behind the scenes, the entire architecture of global finance was crumbling. And the eerie part? The structural flaws that doomed Creditanstalt are not only present today, they're amplified. Back then, banks were overleveraged, hiding toxic assets under layers of accounting tricks, relying on short-term funding to finance long-term loans, and assuming that cross-border interconnectivity would be their strength, not their Achilles heel. Sound familiar? Today, global banks operate with even thinner capital buffers, more complex derivatives, and greater reliance on overnight repo markets and algorithmic liquidity that can vanish in milliseconds. In 1931, the crisis spread because no one understood how deeply entangled the system had become. Today, we pretend we do, but the 2008 crash proved otherwise, and the near meltdown of March 2023, when Silicon Valley Bank collapsed in 48 hours, should have been our latest wake-up call. The real tragedy of the 1931 crisis wasn't just the bank failures. It was a policy response. Nations terrified of losing gold reserves raised interest rates in the middle of a depression, strangling their own economies. They erected trade barriers, hoarded liquidity, and turned inward just when cooperation was most needed. The result? A decade of unemployment, social unrest, and the rise of extremist ideologies that paved the way for global war. We like to think we've learned from that, but look around. Central banks are again hiking rates into economic headwinds. Governments are retreating from globalization, weaponizing supply chains, and prioritizing national sovereignty over systemic stability. Debt levels are at all-time highs. Global debt now exceeds $300 trillion, more than 3 times the size of the world economy. And just like in 1931, the public is being told everything is under control, even as cracks appear in commercial real estate, regional banking, and sovereign bond markets. The most chilling parallel, though, lies in what we don't see. In 1931, few understood that modern finance had outgrown national borders, that a bank in Austria could dictate the fate of a farmer in Kansas. Today, we build a system where a glitch in a London clearinghouse can freeze pension payments in Toronto, or where Chinese property developers' default can trigger margin calls in New York hedge funds. The system is more integrated, more fragile, and far less transparent. And yet, we cling to the myth of resilience. Regulators tout stress tests as proof of safety, but those tests are based on outdated scenarios that ignore black swan events, cyber warfare, or climate-driven financial shocks. Worse, the incentives haven't changed. Bank executives are still rewarded for short-term profits, not long-term stability. Shareholders demand growth, not prudence. And central banks, caught between inflation control and market calm, keep backstopping risk with easy money, only to withdraw it abruptly when panic sets in, exactly as they did in 1931. So what can we do? First, we must stop treating history as a museum piece. The lessons of 1931 aren't about gold standards or horse-drawn carriages. They're about human behavior, institutional hubris, and illusion of control. Second, we need real transparency. Not glossy annual reports, but live, public dashboards showing bank exposure, derivative concentrations, and liquidity coverage ratios. Third, we must rebuild buffers, not just capital, but cooperative frameworks that allow cross-border crisis management without political theater. The Bank for International Settlements tried this after 2008, but national interests watered it down. We need teeth, not talk. Finally, we must redefine stability. It doesn't mean calm markets. It means systems that can absorb shocks without collapsing. That requires less complexity, not more. Simpler rules, not labyrinthine regulations, and above all, humility. Because the greatest danger isn't the next crisis. It's believing we've already survived it. The forgotten crisis of 1931 didn't just predict the Great Depression. It's predicting our future, too, if we keep ignoring its echoes. The bank that failed in Vienna didn't just vanish. It left a ghost in the machine, whispering the same warning to every generation that thinks it's too smart to repeat the past. And right now, that ghost is shouting,